All right, welcome to the section on wave counting. I think as a good way to begin it, I would like to review an example of how not to count waves. So if you'll take a look at this particular chart, you might be interested to know that this is a reproduction of a chart that actually appeared in a stock market publication. Now, you have only listened to 2 hours of instruction on how to count waves. There's a lot more to come, and yet I have a feeling that some people in this audience could point out some errors in this labeling. Anybody see anything wrong with this chart?
3 shortest.
That's a good point. Wave 3 is the shortest. Wave 1 is longer. Wave 5 is longer than that. That's not allowed. Any other problems with it? Yeah. We've got overlap here. This wave 4 goes deeply into wave 2 territory. This is meant to be 5 waves labeled A, B, C, D, E. And D overlaps wave A. Those aren't allowed either. So we've broken some rules here, not just guidelines, but rules. Does anybody see another problem? Well, there is a place where there's a 3-wave problem. You notice this 4? You might say that came into the previous 4th, but how could it when wave 3 doesn't even have 5 waves in it? This Roman numeral 3 has 3 waves in it, up, down, up. And that's not right. So we've got the wrong number of waves in an impulse. It's supposed to be 5 waves, and we've only got 3. We've got overlap from wave 4 and 1, and we've got a 3rd wave, which is the shortest in several instances. You now know enough not to make a single one of those mistakes. So don't do it. Charts such as this, labeled elsewhere, are often a gold mine of instruction on how not to count waves. Very often I'll hear from somebody, yeah, well, so-and-so's opinion is this, and this guy says he's bullish while you're bearish. Well, there's plenty of room within the wave principle for diversity of opinion. You can have different, legitimate interpretations of the wave structure. But most of the trouble comes from people who are not following the rules, much less paying attention to any of the guidelines. They're letting their opinions come first, their gut feel come first, and their analysis come second, and you cannot do that. So don't do it, and you'll stay out of trouble. All right? Well, we've learned how not to do it. Let's take a look at how to do it. The charts that we're going to examine now are of the cocoa futures market. Now this, for the most part, is a reprint of a page from the Elliott Wave Theorist, which was published November 29th, 1982. I'm choosing this particular wave pattern and commodity for several reasons. First of all, this was done already in real time. The bear market that we're going to analyze was analyzed once before in real time, and the bottom within 4 trading days was recognized, and it was published as such. So we're not going to look back at a chart and say, oh, look how neatly it reflects Elliott now. You can see everything now. We saw it then, and we're going to show you how it was done. However, there's some other interesting aspects here. Do you know that the cocoa market is often described with the adjective exotic? It has nothing to do with dancers. It has to do with the fact that cocoa is considered a weirdly acting commodity. Some people think it just doesn't act like most other commodities. It's also hard to categorize. It's one of the foods, but it's not a grain and so forth. So people consider it a bit unusual. A lot of Elliott Wave people might say, well, I'm going to stay away from this. One of the problems in dealing with commodity charts also is that you are not analyzing, most of the time, the price of the commodity. You're analyzing the price of a futures contract, which is a parasite on the commodity. And futures contracts have certain characteristics which make them a bit more volatile, such as incredible leverage. You're not out there buying 3 boatloads of cocoa with a broker. You are actually putting up a little bit of money and speculating on the trend and you are heavily leveraged. Therefore, many decisions are made not because you do or do not want to own cocoa. They are made because your back's against the wall and you're out of money in your account and you've got to get out of the trade. That tends to make the daily moves somewhat more volatile and perhaps cover more ground than they would if indeed people were truly trading the physical commodity back and forth. Also, you should know that the weekly charts, particularly, are what we call continuation charts, which means when one nearby contract expires, the people who keep the long-term data on the commodity futures merely tack on the next chart. Well, very often the next month's futures contract is trading at a different price. So you might see a jump in the price that essentially didn't really take place on the chart. That helps make difficult being certain that the waves you see actually happen because of real trading. And the last reason I chose this particular market to examine is that it is a market which is going down. It's a bear market. And rather than make it easy for us and pick a chart that we're visually comfortable with, a five-wave structure on the upside, I wanted to look very deeply at an ABC bear market decline, particularly the way wave C is subdivided. Well, let's first get a perspective on where the long-term wave structure was at the time. This is a monthly futures chart of cocoa. It begins in 1965 and goes all the way to 1982. Roughly speaking, it shows you a five-wave bull market. Again, we're dealing with futures contracts, and you probably notice, if you're very careful, that there was a slight overlap between 4 and 1. Well, again, in the price of the real commodity, I rather doubt that overlap occurred. Again, we have a little bit more in terms of stretching the prices in each direction because we're dealing with a leveraged futures contract. Roughly speaking, you can see that the five-wave pattern, the basic development is there. A first wave up, a second wave decline, which comes quite near the low and forms a base pattern for the really powerful move up in wave 3, a wave 4 decline, and the fifth wave to new highs. Remember that fifth waves in commodities tend to be the longest and most powerful of the three impulse waves, and this cocoa chart does show that, being a long-term bull market pattern. Now, one thing that's a bit unfortunate, in my opinion, is that commodity chart services issue charts on arithmetic scale. And it makes so much more sense to put them on semi-log scale, where you can see the percentage advances revealed, and usually channels that make more sense. In other words, the lines are more parallel. Unfortunately, long-term charts like this, which show bull markets on arithmetic scale, usually show apparently extreme movements in spike highs that are much more orderly on semi-log scale. Anyway, you can see that the five-wave pattern in all of its essential elements is there, and once the bull market is over, a bear market begins. Now, how many waves should the bear market unfold into? It shouldn't unfold into a 5 because corrections are never 5 waves. In this case, we're going to be looking for an ABC or 3-wave pattern. Ultimately, perhaps it will develop into one of the longer stretched out corrective patterns, which is a play on that 3-wave theme. But at the very least, we need 3 waves against the trend in order to say that the bear market is over or potentially over. Now, you also know from our discussion of guidelines where the bear market is likely to end. Somewhere in the span of the previous 4th wave. And that, of course, is in this area. And as I said earlier, the low usually occurs somewhere near the low of that preceding 4th wave, and of course that's somewhere in this area. So coming off of the high, regardless of when you finally determined that a major bear market was in force, regardless of when you decided that a 5-wave bull market had indeed taken place, you have a piece of knowledge that most people don't, and that is the ultimate likely extent of the decline, right in the area of the low of the previous fourth wave. Okay. Commodities usually begin with sharp reversals. Waves A are usually crashes from a high. And that certainly happened in cocoa. Once wave A was over, wave B occurred, and it was then required that a wave C carry to new lows. Now we're going to spend most of the time here analyzing the movement within wave C, assuming that somewhere during that wave, any Elliott wave analyst would have begun putting all the evidence together to try to make a decision as to when the major bear market was ending. So let's take a look at the weekly chart, which breaks down waves B and C into a little more detail. All right, I've labeled here the end of wave A, which presumably took 5 waves to unfold on the downside. Remember, wave A is now moving in the direction of the one larger trend, which is down, and therefore it subdivides into 5 waves. Wave B is the counter trend movement. Therefore, even though it's heading upward, it is going against the larger trend, and therefore is going to subdivide not into 5 waves, but into 3. And if you look at that chart, that's exactly what happens. There's an upward movement for a smaller A, B, C, to complete wave B. There are a lot of alternatives as to whether or not wave B actually is ending at exactly this point in real time. There's probably a good argument to be made, but there are other corrective patterns. So someone could have reserved the right to say, well, I may change my mind later and say that wave B is probably still in progress. But since you have completed a reasonable corrective pattern, it's time to be on the lookout for the start of wave C. All right, now, if wave B is over and wave C is now in force, how many waves should we see in the subdivision of wave C? The answer is 5. It's going in the direction of the one larger trend, which is down in a major bear market. So we need to count a full 5 waves downward in wave C to determine that the bear market is over. Let's see if we can do that. The first decline from the B wave high subdivides into a down, a rally, a down, a rally, and a final decline. In other words, 5 waves down. 1, 2, 3, 4, 5. That was a very strong indication that wave C indeed had begun. Because now you see you're getting 5 wave developments on the downside again, suggesting that the one larger trend, which in this case is wave C, is pointing down. And of course, you're going to turn out right on that one. Now, once wave 1 is over, what do you know? It's time for some kind of counter trend pattern. In this case, it'll be a rally. And we do get a bit of a rally right here. It could actually have ended there. After all, it subdivides into 3 waves, comes right back in the area of the previous fourth. However, in this particular case, the development fell to a new low in 3 waves, which indicated that this decline was counter trend, and then moved up here into a peak of wave C. In other words, this circle 2 upward corrective pattern was a complex sideways correction. Why? Because prices actually entered a territory below wave 1. So now you can say with certainty that wave 2 was a sideways style correction. This is important because when we get to wave 4, you're going to want to apply alternation to decide what shape wave 4 will be. Notice that wave 2, the upward corrective pattern, ends right in the area of the 4th wave of the preceding impulse wave of the same degree. You knew that before wave 2 started, that that area was the most likely area for the rally to terminate. if wave C indeed was in force. All right, once wave 2 is over, you're going to have wave 3 as a natural next development. Now, this commodity price is now heading downward, not up. So fear is not the driving force. Therefore, fifth wave is not likely to be the longest. The third wave is. And we're back to the typical development of wave 3 usually being the longest wave. And sure enough, wave 1, 2 subdivides, a long third within the third, which is again normal. Wave 4 and wave 5, a long 5-wave subdivision creates circle wave 3. Now, you're starting to get interested in this commodity as one that may be reaching a long-term bottom. You've had wave A down, wave B up, and 3 waves within C. What is left to occur? A rally for wave 4, and then a final 5th wave down. What are your expectations with regard to this? Well, the wave 4 rally is a counter-trend move, so it's likely to peak somewhere in the previous 4th wave area. Wave 5 usually carries prices to a new low, so you would expect when wave 5 comes up that you will take out this low for wave 3. And what have you known all along about where the ultimate bottom is likely to take place? It's probably going to occur somewhere near the low of that previous 4th wave, way back here somewhere, which, as we already saw, is in this area. You know a lot about this commodity. Let's follow it through and see what happens. Here comes a terrifically sharp rally at the end of the 3rd wave, and you already know several things about how that rally is likely to unfold. Number 1, it should peak near the area of the previous 4th wave. In this case, it actually exceeded it by a slight amount. What do you know about the extent of wave 4? What is it virtually not allowed to do, except in a future situation, perhaps by a few pennies? It can't go into the territory of wave 1. So there's no way it could have gone higher than this level. Once you got in this area and count A, B, C up, it's time to assume that wave 4 is over. Is it likely that wave 4 will then have further development? Is it likely that wave 4 is going to come down here and make a new low and then rally back up and get complex and be sideways? The answer is no, because you've already had one. And by alternation, since you've had one complex sideways correction, wave 4 is likely to be simple. Over rather quickly, very sharp against the trend, and not make a new low within it. All right, and that's exactly what happens once you count an ABC rally right up to where circle 4 is here. Now, what are you looking for? You're looking for the 5th wave down. How many waves should it subdivide into? 5, because it's going in the direction of the one larger trend. It's likely to make a new low below wave 3, and it's likely to stop somewhere probably higher than that area of the previous 4th wave. Your knowledge is increasing as the bear market is progressing. All right, let's look how prices actually moved. Right off the top of wave 4, you had a decline, a rally, a decline, a rally, and a decline. A very pretty 5-wave structure down to complete intermediate wave 1, this little 1 in parentheses. Notice if you look closely at that the internal subdivision is a very nice 5-wave structure, even on this weekly chart. Then comes wave 2, which is an ABC, does not carry to a new high. Wave 3 unfolds. Can you see the subdivisions in this one? Down, up, down, up, down. A beautiful 5-wave subdivision within wave 3. Notice that wave 3 is longer than wave 1. So already you can now begin to apply another guideline. The 5th wave down, intermediate wave 5 in parentheses, will probably be approximately the same size as the 1st. That's the idea of equality between waves 5 and 1 when 3 is the longest. All right, once wave 1, 2, 3 intermediate are over, it's time for a 4th wave. Wave 4 gets underway. Notice that it peaks exactly in the zone of the preceding 4th wave. That's the low of the 3rd subdivision, and this is the 4th. Already having told you where the likely resistance level would be. And now you're getting even more interested. This wave 2, by the way, is a sharp correction. There is no new low made within it. How was wave 4 supposed to develop? It was supposed to have a new low and be very complex. Notice it had an A, and this B went to a new low, and then we had a C rally to complete wave 4. We're going to look at the detail of that area of the chart on the daily chart now. This is a weekly chart of futures. We're now into the last portion of the declining phase, and you go back to your chart book and you say, now it's getting serious. I want to start following this on a daily basis to try to decide when the low is in place. This is a blow-up of the last 2 waves in the sequence. On the weekly chart, we're now looking at them on a daily chart. This is the end of the 3rd wave, and notice, as I said before, wave 4 was a complex pattern, a sideways pattern, indicating it would probably have a movement to a new low within it. It did so, A, B, wave C to the upside. For those of you who are versed somewhat in Elliott analysis, you'll notice that this is a diagonal triangle, which is the only formation which allows an overlap, and Dave will cover that this afternoon. Wave 4 ends, again, it was in the area of the preceding 4th wave, just where it should have ended. Now what are you looking for? You're looking for the 5th wave down, the 5th intermediate wave, the one in parentheses. How many waves should it subdivide into? 5 waves. It's likely to carry to a new low, below wave 3, and is likely to end somewhere near the major bear market's preceding 4th wave. And now it begins to develop in an interesting way. Wave 1, wave 2, which is quite complex, you notice, in a sideways shape. Wave 3 carries you down to this particular low. Wave 3 is longer than wave 1. Then comes wave 4, which is sharp and against the trend, unlike this rather complex sideways structure. And then you're ready for wave 5. If you look very closely at the daily ranges, even within this last minor wave 5, you can see a decline, a recovery, a sharp movement down with a gap in the center, that's the point of recognition, ending a 3rd wave, a little rally for the 4th, and a decline into the intraday low at the end. If you had an hourly chart and wanted to look at the subdivisions of this last decline, you would see 5 waves down into that low. If you went to your quote graphics machine and checked the 5th wave on the 5-minute bar chart, you would see 5 waves down right into that low. Well, for the moment, let's just assume that you're working with a daily chart. And for the moment that you've counted it correctly, and you've counted 5 waves down, you're at a new low below wave 3, you're into the area of that previous 4th wave low which preceded it years ago. You've counted an ABC from the top, 5 waves in A, 3 waves in B, 5 waves in C. Every one of the declining impulse waves within wave C subdivides into 5 waves. You have now satisfied all of the rules and most of the guidelines required under the wave principle. If you are to enter an order, you'll probably wait for a reversal to indicate that wave 5 is possibly over. You put your purchase in as soon as you decide that that has occurred, and where does your stop go? Right there at that low. And in this particular case, you have caught the end of a multi-year bear market, or at least the first major phase of a multi-year bear market. And look what you did to identify it. You counted to 5. That's all you had to do. Did you know what the fundamentals were? Did you know how many tons of cocoa were sitting in stockpiles? Did you know how many ships were laden with the stuff in the harbors? Did you know whether the crops were doing well that particular year? Did you know whether anyone had developed a substitute for cocoa lately? Did you know what the trend of chocolate consumption around the world was? You didn't know any of that. How about the technical aspects that most people might be interested in? Did you know what the psychology of investors was due to, say, the bullish consensus among advisors? You had no idea how many bulls or bears there were. You weren't following the put-call ratios or the open interest in the futures. What about all of the Elliott wave things you could have looked at? Did we do any channeling? No. Did we do any Fibonacci calculations to estimate where this might have bottomed? We didn't do any of that. There are some guidelines we haven't discussed yet that were not applied. All you did was count to 5. And you were able to identify the end of a bear market that was fooling people every single day it was in progress. Now, let me cover one other aspect of the wave principle that I think is very valuable, and that is what it does for you when you are wrong, when you make a mistake. Let's assume, for instance, that you were watching this daily chart and trying to pinpoint the low of the final 5th wave, and you recognized wave 1 and wave 2, and then this very severe decline got underway, and you said, oh man, that's sharp enough for a wave 3, and here's a bounce. There's no overlap. I'll put my 3 right here and my 4 here. So when the market makes a new low and then reverses, you buy it, saying we've had a 3, 4, 5 into a bottom. Where do you place your stop? 1 tick under that low. Because you see, if a pattern is over, it's over. There's no fooling around. You're either right or you're wrong. You either caught the low or you didn't. If you didn't, you may have only missed it by a small amount. On the other hand, you may be wrong by a mile. Why take the risk? If that low is taken out, get out of the position. How much have you risked? A few percent and maybe the commission. You've got your low here after the bounce. Market comes back down and takes you out, bounces again, and you're going home saying to yourself, well, I'm pretty miserable. I thought I was catching a low here and it took me out. But how miserable are you compared to the guy that tried to catch a low about 3 months ago? And he's still long. So you sleep on it for a couple days and you say, well, wait a minute now. I remember when Bob was giving that presentation, he said that wave 3 very often subdivides into a 5-wave sequence. Maybe I should put my 3 here. My 4th wave peaks here just slightly above the area of this previous 4th. And here we have a 5th wave down. There's a little gap in here too. And another reversal. That's a pretty big reversal day. I'm going to buy it, put my stop there. Well, you have now caught the exact bottom at very minimal risk. The other beauty of this entry, this kind of entry, is that you can now let your position run a long way, understanding that your ultimate risk in the position is almost 0. Now, I've been stopped out plenty of times in my life and in the Elliott Wave Theorist, but almost never with a major loss. We have rarely been caught invested for a long period of time on the wrong side of a market. And it's strictly because the wave principle, if properly applied, if objectively applied, does not allow you to do it. Now, that's not to say that sometimes we make mistakes and we say, well, look, I'm going to let this one go because I'm so sure that we're almost ready to come into a high or a low. I mean, I've made mistakes like that myself. Those are human errors, though. They're not errors that the wave principle dictates or even suggests you should be making. Well, here's the outcome, just to orient you to it. That was the exact low, at least for quite a period of time. And cocoa then soared from 1,300 to 2,800. And just so you realize that this just never stops, I'd like to show what happened some time thereafter. This was the low we caught right there, the 5th of the 5th of C. Cocoa had a powerful advance from there. And without going through all the Elliott wave ramifications of this, I want you to understand how psychology was working. What kind of psychology do you think was present at that low in December of 1982? The bleakest imaginable. The quotes in the financial press on cocoa, when you could find them, it's not exactly the most popular thing to follow, were negative. They were bearish. They were all giving arguments as to why cocoa would go much lower. That is normal. This is what you should expect. This is what is required for a bottom to be made. Of course, the psychology had changed by this time. Now let's read what some analysts were saying when cocoa was at 2,700 and moving vertically. You see this advance here? That's just soaring straight up. So it's almost as if it's a gimme to make comments about how high it's going. It's holding up like a Picasso, one guy says. The next stop is 3,000. This person is looking for a rally over the next few weeks of 2,800. It's in a blazing bull market, says another one. Prices to rise, not necessarily in a straight line, but certainly much higher. Here's someone else looking for 3,000. Here's someone else looking for 2,800 to 3,000. Now, it's not really too tough when it's been going up, $100 a week, and is currently at 2,700 to say it's going to go to 3,000. I mean, that's kind of just normal extrapolation. But you know what? Never made it. Peaked at 2,800 on a spike, right with the most ebullient psychology, and turned down from there. One of the most interesting comments about cocoa during this rise was how mysterious it was that it was going up, because everyone knew there were many, many stockpiles of cocoa being held. And they couldn't understand why the price was going up. The reason is it had already gone too far on the downside, and it was time for psychology to change. And this goes on and on. They're bearish at the bottom, bullish at the top, bearish at the bottom. It goes on forever. If you've missed a move in a market recently, don't worry about it. There's another one coming up, and it'll have the same characteristics, the same wave shape, the same psychology, the same kind of news that's trying to throw you off the track. And once you get used to all that, it starts to be like a replay. And you're starting to watch the same thing over and over. And after a few years, something may happen to you, which has happened to me. I don't look at the name of the chart anymore. I don't care what it is. I've seen this happen before. I look for 5s and 3s, and I look for the rules to be satisfied, the guidelines to be satisfied. I don't even know sometimes when somebody puts a chart in front of my nose whether I'm looking at a 5-minute bar or a weekly bar. You interpret it the same way. And once you get used to that and start ignoring what's irrelevant, it will not only make you a better trader, but it will keep you from getting tripped up as much by listening to all the news. Now, news has some value, but it's exactly the opposite of the way most people think it has value. And that is, let's suppose you've decided that a new bull market has started in the market you're watching. And all of a sudden, a piece of very bad news comes out, and the market, probably because it was at the end of a wave 1 or a 3 or a 5, on the way up, moves sharply lower. Most people are looking at that news and saying, oh my gosh, terrible news, I better get out before I get hurt. What's your answer to that news? Buy. You look at the wave structure and decide where the low should occur, and you buy it. You use that news to your advantage, not your disadvantage. And that's what having a perspective, an overall perspective on the market can do for you. With these rules and guidelines and wave counting exercises that we've done today, you could quit right now and you would know more about the wave principle than 90% of the people who are putting letters and numbers on charts for publication today. As long as you stuck to those rules and guidelines, you would know more than they know, and you would do better than they do. And I'm convinced that you would be able to assess markets better than 80 or 90% of the professional market analysts out there today also. However, there's still a lot more of value behind the wave principle. There's a lot more to learn, and that's what the rest of today and tomorrow are going to be dedicated to. So stick around. Thank you.
If you would like to participate in the wave counting quiz, examine this wave structure and label the chart in your workbook. Robert Prechter's discussion of the correct labeling will begin in 30 seconds.
All right. Got a little surprise here. I know you weren't expecting this at this time. I think it's time to take a look at our quiz. Now, apparently, you were asked to turn one in a while ago, and none showed up. At least none with your signatures on them. But I'm sure some of you figured this one out. Let me ask this question first. How many people here were able, in their opinion, to count successfully a 5-wave upward movement? Okay. How many people thought it was something other than a 5-wave movement to the upside? Okay. Well, I think it is extremely difficult to count this as 5 up. I would go as far as to say impossible, but there would probably be one way you could get away with it if absolutely no other count were available. I'm not going to show it to you because I don't want anybody to try it. However, this is clearly an ABC count. It's a very simple corrective pattern, not complex as you might think. In any case, let's try 5s first. Would it be acceptable to go 1, 2, and then have a subdividing 3rd wave up to there? The answer is no. That's right. You've got overlap between wave 4 and 1. Could you have an extended 1st wave, a 2, 3, 4, and somehow get a 5 out of that? No, because the 3rd is the shortest. Every time you try to make a 5 out of this, you should have had problems. You should have ended up breaking a rule and therefore saying it can't be a 5. The quickest way to deal with this, and it involves something that a lot of people have difficulty finding until they've seen a lot of them. It's a triangle in the middle. So it's a simple ABC count. Now I must admit I threw you a little curveball by saying this had to come down at least to this level, but I did say at least. And eventually, of course, you probably see something like that. That is a rally in a bear market. The first clue to identifying the fact that you're in a corrective wave is that trying to count 5 waves up, or even the beginning of some 5-wave upward pattern is difficult or impossible. And the harder it is, the more likely a correction is in force. So I think this may not be the only interpretation, but it's the best one. It's the neatest. It's the most economical. One reason it's better to use a simple ABC count when you have a choice between counting something as an ABC or as a double zigzag, ABC x ABC, is that this could easily be followed by an X wave itself. X down to here, you see, and then another ABC pattern. And if you'd already counted it as a double zigzag, you wouldn't be expecting that to happen. In this case, it counts as a simple correction quite easily.
The purpose of this quiz was to reveal whether you had learned 2 key rules of the wave principle well enough to know that the formation was not a 5-wave structure, but had to be a corrective structure. For a full understanding of the patterns available so that the ABC wave count would have been precisely identified, be sure to pay close attention to Dave Allman's presentations on impulse and corrective waves.